This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We've said that measuring and controlling inflation is important for governments. Inflation which is very high is wasteful, it's unfair to savers and those on fixed incomes. But if we're going to control inflation, then of course it's important to measure it. And how can we do that? Well, really there are two situations. First of all, we can very easily measure inflation for individual products. So here we have product A, and we see that in the current year, let's say this year, it's costing $2.50, whereas the base year, let's say it's last year, it only cost $2. So what we have is for product A in here, we have it going up to $2.50. It had cost 2. The index there, sometimes we were told be 125, which means that we're 25% up on what it was last year. An inflation rate of 25%, or an index of 1.25, or very often this is based on 100 and you say it's 125. Product B, we see it's now being sold at 4 per unit. Last year, in the base year, it was being sold at 3 per unit, so that's 1.33. You could call that an index of 133, or it's equivalent to an inflation rate of 33%. We've added on a third, basically, of the cost from one year to the next. A very high inflation rate. However, that's of limited interest to most people, because most of us are not just buying one product, we're buying a whole collection of products, sometimes it's called a basket of products. We buy food, we buy petrol for the car, we buy electricity and gas to heat our homes, we pay for mobile phones, we pay for entertainment. The varieties of expenditure are very, very wide. And what really affects us is not just how one product is inflating, but how this, if you like, basket of goods, as it's called, how it's inflating. So here we have the basis of a bit of a problem. This example here, let's say we have a very limited basket. Somebody buys just two products, A and B, but two things are changing. We know the price is changing from 2 to 2.50 for A and 3 to 4 for B. But also you see that the quantity, the volume bought is changing. So two things are changing at once. So how can we isolate or how can we calculate an inflationary effect? And basically there are two approaches. One is to use base case volumes, base year volumes. So if we look at what's happening this year for product A, well, we know the price is $2.50, but what we're going to do is we're going to base the cost, if you like, on $2.50 times the historic volume. And then we have product B, where the current price is 4, and in the base year we bought 50. So this is kind of saying, this is what the goods would cost you if you were still buying the same quantity as you bought in the base year. And on the bottom line, we'll be saying what we have in here, where we have product A, it's costing 2, and in the base year we did actually buy 20, and in the base year it's costing 3, and we had only 50 in there. So what we've got in here, 250 times 20, I think that's going to be 550. This is going to be 200. And then in the bottom, we're going to have 20 times that's going to be 40 plus 150. So we have 250 over 190. So the historical based inflation there at 250 divided by 190, it's coming in at about call it 1.32, or about 32%, or an index of 131. And that probably looks about right. It's going to be somewhere between obviously 25 and 33 in here. We are product B is rather more important in all of this than product A, so we're up near the rather like the product B inflation rate, which is in that. Yeah, I think that's correct. The other approach is to say, well, maybe the old volumes are rather busted now. We could base this on current. So, product A, we have got 250, and this year we bought 30, and product B in before, and this year we bought 60. I was saying, well, had we bought those quantities, current quantities, had we bought them last year, then product A would be costing 2, and we would have bought 30 because we're basing it all on current volumes, and product B in here would be costing us 3, and again we'd have bought 60. So we've got it in here. We've got here, I'm going to have 2.5 times 30, 75 plus 240 over presumably 60 plus 180. So 75 plus 240. On the top line we have 315, and then the bottom line we're going to have 240. Based on this, we have about 1.31. So 31% inflation measured that way, or inflation index of about 131. Now here the differences aren't very great. It's really here to illustrate how to do it, really. You either say, well, let's see what current consumption would have cost last year, or we're kind of saying, what would last year's consumption cost this year? Note you don't change two things at once. We have never, in either of these calculations, taken current year's quantity times current year prices on the top, and historical quantities and historical prices on the bottom. Okay, we've in both cases here we have stuck with current quantities, a big one, historical quantities on the top and the bottom, and here we've stuck with current quantities on the top and the bottom. We just in a way move one thing at once. Now you'll see in the notes, this is set out again, you also see something called chain indices. And what chain indices say is you could have, say, started in the year 2000, and you could have measured inflation from 2000 up to 2010, then from 2000 up to 2011, from 2000 up to 2017, etc., etc. That's called a base index. Or what you can use as a chain index, you could say, well, the inflation between year 2012 and 13 is maybe 3%, then between 2013 and 2014 is maybe 2%, and so on. In other words, you calculate each year's inflation index separately. The journey that's made overall is going to be the same. We either are getting from the year 2000 to the year, let's say 2017, in like one big jump, or we're doing it in 17 or 18 little jumps in there, but it should end up at the same place. Trade cycle. Trade cycles, just to get you into some of the things which is happening in trade cycles. It has been noted that most economies, indeed the world economy, goes through some sort of repetitious cycles. Typically 11, 12 years it would seem to be, though that is not absolutely guaranteed, of course, of where there's boom, if you like, very buoyant economies, and then there is a trough, basically a recession. So here we have what's called a trend of the economy in the country gradually going up here. But then the detail is we have bad times. You kind of got recessionary times in here. And then we have boom or peak times. And then maybe something happens, people lose their confidence and goes down and so on like that. Now these trade cycles give governments a headache. Because what we've got in here, in this kind of trough areas here, where the economy is way down and not doing very much, is of course tends to be great unemployment. The aggregate demand is down, the aggregate production is down, and so on. People are kind of depressed, they're uncertain about the future, and so on. They are saving a lot of their money, and so on. And what governments want to try and do is to improve the economy so that they get more people employed and so on. So governments will try to stimulate the economy, maybe by reducing interest rates. But then what happens, everyone gets terribly optimistic in this expansion period here. And very soon governments can find that the demand outstrips the supply and suddenly inflation begins rocketing away and the government has to try and put the lid on things. Just yesterday, from when this is being recorded, the United States has announced a small increase in interest rates because they thought the economy was maybe expanding a little bit too rapidly and there were going to be dangers from either sucking in imports or inflationary pressures. But then what happens usually is people, it's rather overcooked, people maybe overreact to interest rates going up and people are predicting, oh, there's going to be a recession coming in, and so we kind of go down again like that. It's very, very difficult for governments to keep economies on an even keel, but they try to. But too much boom and bust, as it's sometimes called, is bad for economies and is, for many people, is terribly uncomfortable if they either lose their jobs or are frightened of losing their jobs or go through several years without any pay rise. It can be kind of unsettling and depressing and so on because you feel you're not actually getting anywhere. Governments can try to control the economy by their methods of finance because the government spending and taxation policies and so on have had a huge influence on the boom or bust, the recession or the reduction of an economy. Governments can obtain money by taxation or borrowing or selling state assets or printing more money. Let's look at taxation. Governments can introduce taxation in a number of different ways, and there are some terms that you need to know here. First of all, you have what's called a progressive tax, and a progressive tax is where proportionately richer people spend more, proportionately. So many income taxes are progressive, so up to a certain level of income you may pay no income tax at all. Then maybe once your income gets to a certain level, you begin paying 20% on any income in excess of that. And then once your income gets very much higher, then maybe you begin paying 45% on income over that. So proportionately you begin to pay more in tax as your income increases. A regressive tax means that proportionately a poor person spends more of their income in tax than a rich person. And a good example of that is usually sales tax, or as we call it here, IVA or VAT, value added tax. So if, let's say, you have a value added tax of 20%, this means if you're buying something for, let's say, 500, then the tax there is going to be 100. And it doesn't matter whether you're rich or poor, to buy those goods, 500, the government is going to add on to that tax of 100. And the 100 could be a lot of money for someone who's relatively poor, but not very much money for somebody who's relatively rich. This is a regressive tax. A proportional tax is one where everyone pays the same proportion of income. So it'd be a bit like having income tax at 20%, but starting from the very first dollar you earned, and even if you earned $1 million a year, you'd still be paying 20% of that. Proportionately, it stays the same. Examples of direct taxes, it's really where it's the person being taxed kind of pays directly to the government. But examples here, income tax. So income tax, corporation tax, and so on are all what's known as direct taxes. Something like VAT is an indirect tax. VAT, basically you pay it on your purchases, and then the shop from whom you bought the goods, they pay a proportion of that purchase price on to the government. That is an indirect tax. Governments sometimes think that indirect tax are less noticeable than direct taxes. And then we have something that should actually say ad valorem. An ad valorem tax is a tax which is based on the value of the goods. So VAT, 20% of the value of the goods, is an ad valorem tax. But some taxes do not depend on the values of the goods. Some taxes depend on units. For example, in the UK, there is very high tax on cigarettes. But it doesn't matter whether you're buying a cheap brand of cigarettes or an expensive brand of cigarettes, the tax on 20 cigarettes is exactly the same. Again, we see it in the UK on wine, or, for example, it doesn't matter whether you're buying a bottle of wine costing $5 or a bottle of wine costing $50, the tax is the same. It's not related to the value. It's done really per unit. Government borrowing. Another way that government can raise money is by borrowing. Borrowing from members of the public, the government borrowing from other governments, borrowing from institutions. The government issues bonds, treasury bills, as they might sometimes be called. This allows the government to raise money which can then spend on government projects. Great controversy at the moment that many countries think that the borrowing is far too high, because of course if you borrow then you have to pay interest. And government has to pay interest to the people lending it the money, and at some point if government borrowing is very, very high, how is the government going to pay the interest? Is it going to have to default on its loans? And then this then pushes up the cost of government borrowing to even higher levels. And at some point, people may not want to lend the government any more money, and then we have a bit of a crisis. Since 2008, many countries have been trying to cut back on government borrowing, and the way they do that is principally by trying to cut back on government spending. But we'll see that in the next slide. Selling state assets. In the 1970s, for example, in the UK, the government owned a fantastic array, really, of industries. It owned, for example, British Airways. It owned the gas companies, the electricity companies. It owned the railway company and so on. And one of the great innovations, really, that began in the 1980s was to privatize state industries. It was reckoned that governments aren't very good at running, say, airlines or running maybe gas distribution systems. And governments throughout the world began privatizing many of their state incomes, and this was an important source of income to governments. And then we have simply printing more money, or as it's called nowadays, quantitative easing. The government simply prints more money and distributes it. Now I think you will see that this is likely to cause inflation. So if you're a government employee and this week you get paid $500 and next week you get paid $1,000 simply because the government has printed more money to pay its employees by, then you rush out with your extra money and you're going to be spending on more goods and so on. This is going to increase inflation. So printing more money can be used as a valid way to try to stimulate the economy, but at some point it is probably going to give rise to considerable inflation. What other policies the government have to try to influence the economy, to try to avoid too much boom and bust as we saw in the kind of trade cycle? And really there are two families of policies which the governments can look to. First of all, there is fiscal policy. And fiscal policy, fisc, here the word fisc used to mean the king's purse. It's where the government gets money from. And it can get money from tax, and it can get money from borrowing. And this can be used in government spending. And those have to be essentially in equilibrium. If the government wants to spend more, it either has to tax its citizens more or it has to borrow more. If the government wants to reduce borrowing, it either has to reduce spending, and of course this was controversial here. Some people said that when there was a financial crisis in 2008 and governments thought they were borrowing too much, that the government reducing spending, the so-called austerity policies, was not what should be done. That if the government wanted to reduce borrowing, what maybe it should do is to increase taxation. But of course increasing taxation will have other effects on the economy. So keeping these three in kind of balance is one way in which the government can influence what's happening in the economy. Another way is monetary policy, which is interest rates and money supply. If the government increases interest rates, people will be willing to borrow less, and this puts a lid on consumption and will stop the economy expanding. If interest rates are reduced, then people see it's going to be very cheap to borrow. More people will go out and get loans, so they'll be encouraged to buy more goods, and this is sometimes used to try to stimulate the economy to bring it out of recession. And of course, for a number of years now, interest rates in many countries have been almost trivial, like 1%. In the 1980s, I can remember interest rates being up 12-15%. Money supply, of which printing money is one way of influencing money supply, but also in money supply there's affecting banks and how easy you make it for banks to lend money. For example, if you said to a bank you cannot lend to a customer more than 50% of their income, then you're putting a really quite sharp limit there on how much money banks are actually allowed to lend to people. But if you said to banks you're allowed to lend to people 100% of their income, then of course you are permitting banks to lend much more money, and many people will take up those offers, and again that will stimulate the economy. Finally, in this chapter, we need to look at what's called the multiplier. And the multiplier is looking at how an initial and perhaps small stimulation, let's say by the government, can end up being quite a significant stimulation to the economy. Let's say what happens is that the government gives its employees an extra 100 million. So what we're saying here is the government is going to stimulate the economy by simply spending an extra 100 million on government employees, raising their salaries by 100 million. So you receive the extra money, and some of it you will spend and some of it you will save. Now what we've assumed in this here, and it doesn't have to be like this, that there's a marginal propensity to save of 25%. So if you received 100 extra in your pay packet, you would save 25%, kind of stick it under the bed for a rainy day, and you would spend 75%. So that's what we're doing in here. Out of this 100 that's being received into the economy by, say, government spending, 75% is spent. And of course that's spent on goods. And when it's spent on goods, then that money is going to go to suppliers. It's going to go to the employees of the companies producing those goods. So in a way, their wages collectively, in aggregate, are going to go up by 75 million. And of course, they are going to be spending 75% of that. So what we're doing down here is each time we go through this, the next band of consumers, if you like, or the next band of people receiving this money is going to save 25% and is going to end up essentially spending 75% of this. And so the initial expenditure we have in here is kind of going round and round and round and round, and is going to give rise to much higher overall stimulant to the economy than the initial 100. It is being multiplied up. How much is it going to end up with eventually? Well, it is the initial here times 1 over the marginal propensity to save. So, if we have 100 million being put into the economy initially, and a marginal propensity to save is 0.25, effectively this is going to result in an extra 400 million really being in the economy and available for stimulating and for consumption and so on. If the marginal propensity to save were only 10%, then what we're going to be having is here, the 100 over 0.1 is equal to 1,000. Because people are keeping much less back each time, only keeping 10% back, they're throwing out and spending now 90%. The effect of the initial stimulus is much, much higher in the economy. So the multiplier is a very important effect, that when the government stimulates the economy, they're actually going to get quite good value for money. You know, spending 100,000 or 100 million ends up as though they were spending 500,000 or a bit over 400,000 or 400 million, and can be very, very effective as a stimulant.